So here's the deal. You're paying $1,600 a month rent for a house, and you'd like to buy that same house. And the mortgage payment would be $1,300 a month, but the bank says, no, you are not approved for a mortgage. That doesn't seem very fair, does it? Well, I'm going to try to explain a little bit today why that might be the case. So for example, let's say that you make $60,000 a year, and you are renting that house for $1,600 a month. And let's say that house is worth $250,000. So if I run a quick mortgage calculation on a $250,000 house, 25-year amortization with a 4% interest rate, the mortgage payment every month is $1,315, less than $1,600 a month. But if we were to look at you from a bank's point of view, and let's say you also have some minor debts, maybe a car payment for $600 a month, and that's it, you would not qualify for that mortgage. Now, why is this? Well, at the end of the day, it basically comes down to a bank's risk tolerance and government regulations versus a landlord's risk tolerance. So typically landlords will do some type of income screening, but they'll be a little more lenient and allow you to rent something where your rent payments are a little bit higher. But the banks are very rigid in their rules. So under that example I just gave you, you would not qualify. So let's hop over to the whiteboard and crunch some numbers. Okay, so here we are at the whiteboard. I'm gonna go over some numbers, the example I just gave. So in this example, we're saying you currently have an income of $5,000 per month, 6,000 bucks per year. And you're currently renting a house worth $250,000 that you rent for $1,600 a month. And you can make that payment just fine. So if we take that same house for $250,000 and we say we're gonna get a 25-year mortgage on it for 4%, your payment's gonna be somewhere around $1,315. So a lot of people will say, hey, $1,315, that's less than $1,600, why am I not approved? Well, here's the calculations that the bank are doing. So first, we need to talk about these two guys right here. Your gross debt servicing and your total debt servicing. These are just ratios that banks use to determine your affordability. So to calculate the gross debt servicing, you take your mortgage amount and you divide it by your income. In this case, that's 33%. And your total debt servicing, you add up your mortgage, your heating, your tax, any other loans or lines of credit or debt you might have. In this example, I used a car loan for $600. You add all these up, divide by 5,000, and you get a TDS of 45%. Now, the government of Canada and the banks in Canada have regulations which say your GDS must be less than 39% and your TDS must be less than 44%. So you can see in this example, you're at 45%, so you just don't quite qualify. So that's just one simple example, and this is a real life example with numbers that make sense in Regina of why you might be able to afford rent versus why you'd get denied for a mortgage even though it's less. And like I mentioned in the first part of the video, it really comes down to the bank's risk tolerance and you must having to meet these numbers versus a landlord saying, you know what, I think they're pretty close, they can probably afford it, let's give them a shot.